Hi everyone, it's Alex here at Cestrin Capital Research. Welcome to our weekly webinar. It is Wednesday, the 4th of October, currently 5 p.m. Eastern for the benefit of the tape. So today we have a combined webinar for both our Substack Tech Select Pro members and also our Seeking Alpha Growth Investor Pro full members. I have a clash tomorrow, Thursday. We normally run our Seeking Alpha webinar, so we'll do the two webinars together. The topics this week, at any rate, are perfectly aligned, so it makes sense to do the two together. So welcome everyone. We have many new members joining us today. Delighted you've chosen to join one of our services. Thank you. There's 1,000 stock services out there, so we're delighted that you're spending your time and your hard-earned money with us. Hope you enjoy the services and find them useful in your work. Okay, so today I want to run through really two topics only. So the first of which is let's look at the equity indices. There's been a sizable sell-off, as we know. Last few days, there's been hints of a reversal. That was true again today. So whether the bottom is exactly in, who can say, but it certainly feels like a bottoming process. So let's take a look at how they all look in the shorter and longer term. As usual, we'll look at the S&P, the NASDAQ, the Dow, and the Russell 2000. What I want to do then is run through some of the single stocks that we have in our accumulation range. And if you think about how this year has gone, 2023, we spent the back half of 22 and early part of 23 with lots of stocks in the accumulation range. Many of them then moved up into markup, started to show some weakness, and we went through looking at which of those stocks might be sold in their entirety or partial gains taken or hedged or whatnot. And with the sell-off, where I think we are now again is let's look for the opportunities to add to some of these accumulators, either new positions if they're not stocks you've owned before, or perhaps adding to existing positions, be that at a higher or lower price compared to your in cost. But I want to look at some of those names that are looking pretty attractive right now. And we've got two buckets, a bucket of four that have great fundamentals and are also showing stock weakness, but in that accumulation zone. And then another four where the fundamentals, frankly, aren't very good, but the stocks look bullish anyway. So we'll look at those in a moment. Before we do any of that, I want to run through our usual disclaimer, which is on your screen right now. And I'll just read that out for the benefit of the tape. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Cestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Cestrin Capital Research. Cestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's take a look at some charts right now. Let's start with the 10-year yield. Now, rather surprisingly to me at least, it looks like you can in fact chart the yield using our standard Elliott wave and Fibonacci method. Particularly if the yield tops around here, then it'll have charted really, really well to this method. So if we go back to the COVID lows right here, the yield was rock bottom just above zero, result of the low federal funds rate, all the stimulus of various kinds. We get a brief spike up into March, a wave 2 down into August 2020, a wave 3 up, peaking at 3.5% in June 22. And that is a pretty big wave 3, almost a 3.236 Fibonacci extension. Fairly shallow wave 4 down, not quite a 38.2 retrace, and then a final push up in October 22 to peak at around 4.3, 4.4%. And that coincided with the equity market lows in October 22. The yield then entered, what looked like a down channel, something like this. For a while, broke that in June this year, and then started to move up. And if you look where the yields got to, as you know, Fibonacci Elliott wave 5s typically terminate somewhere between the 61.8 and the 78.6 extension of waves 1 to 3 combined, with that extension placed at the wave 4 low. And you see this time and time and time again with wave 5s. Now, if the yield tops out at, here 5%, 5.1%, something like that, then this thing will have respected these Fibonacci levels really, really nicely. And we'll see if it rolls over. But what we've been saying for some time now is, don't be surprised to see that yield get up to 5% or thereabouts before a rollover. Now, the yield drop today was about 1.5 points down today, I think. So we'll see if that is sustainable or whether it's just a short-term drop before another run up. This is probably the single most important thing that has to change for stocks to run up, at least in the short term. And you can see here that, equities are significantly above where they were in October 22. So I think you can say that in the longer term, you can't say yields up, stocks down. You can certainly say that short term, but longer term, I think it's quite possible for yields to drift up while stocks also move up. The shock move up in the yield, I think, is what's caused this recent sell-off. I'm not so sure it's just the amplitude of the move. I think it's the compressed timetable of the move. Anyway, let's go on to look at the S&P. So let's first of all look at let's just update TrendSpy. Let's first of all look at the larger degree of the S&P. So this is the SPY ETF, and for those of you who are recently joining us, let's just run through the history here. This is the same chart I've been using for a couple of years now. So this is a 5-wave up chart, we think. Starts somewhere in 2015, 2016, off the chart to the left here. We get a wave 1 up into just before the COVID crisis hits. We get a sharp 78.6 retrace down into the COVID crisis lows. Q1 OPEX hits, flood of federal liquidity comes in, and we get a big wave 3 up, the 1.618 extension of this wave 1. But it's quick, right? The wave 1 takes 4 years-ish to deliver that. It loses almost 80% of that value in a couple of months. And then it adds, it's back to a 1.618 extension in the course of only less than 2 years. Wave 4 down, again, pretty quick. 50% retrace of that wave 3 up. And that takes place between January and October 22. Now, in truth, although much of 2022 felt like the market would never stop going down, really the SPY entered a horizontal range in around April, May of last year. A couple of spikes below it here in June and here again September, October, but mainly it went sideways in a big accumulation range. And you can see if we switch on the volume by price indicators here and we set that clock to start at the all-time high, this big volume spike here that you look at, just right here, that is sideways accumulation here at these lows. And we've talked for some time about, well, what's this spike here? Is it distribution? Could it be that this is just a bear market rally and a rollover and it's going to sell off now? And my personal view throughout this thing has been no. I think the volume here is a result of the many asset managers that missed this bottom, that weren't buying from May, that didn't buy the October lows, that didn't buy the January lows, and they just missed it. And so I think that, whether by design or by accident, we get this sell-off now. I think this spike in volumes is accumulation by large account players, a sort of a do-over, right? So if you're buying the S&P now, you're paying the same price as you would have been in August last year. So you get, pretty much a do-over, or back to May this year is another way to look at it. So I think that this is reloading, or perhaps loading for the first time if you've been bearish all the way up here, in preparation for a run to all-time highs, I think. If we were to look at the shorter term on the ES futures, again, this is trading really, really nicely to technicals. So if we look at the move up from the October lows, we get a 1, 2, 3, 4, 5 wave up, completing early December for that large degree wave 1, a 61.8 retrace wave 2 down here, and then we start this long wave 3 in December. And we get this 1 up, 2 down, 78.6 retrace, 3 up, big wave 3, nearly a 200%. Wave 4 down, it looks like a 0.5 retrace. And if you look at where, if the S&P moves up here or it drops a little bit further and then moves up, you can see that wave 4 has retested this wave 1 high, which is a classic, textbook place for a wave 4 to bottom out. So there's a good chance technically that this is the low, and if not here, then a few dollars lower. And then we think we're back into a wave 5 up within this large degree wave 3. And if we are, then that's going to take, I think, the S&P probably to a new high. Then a large degree wave 4 down and a wave 5 higher. So this is how we're looking at the S&P or the ES right now. Let's look at the NASDAQ. Okay, it's pretty much the same story. It's the same chart. It's just more compressed on the timeline and expanded on the amplitude. So let's have a look at this. So we get the low in December 18, Fed reverses policy here from tightening all through 2018 to loosening in 2019. So we get this wave 1 up just before the COVID low at peaks, another 78.6 retrace, a wave 3 up, but this time a 2.618 extension, not a 1.618 as you saw in the S&P, but a 2.618 in the NASDAQ. So again, NASDAQ wave amplitudes are higher, more volatile than the S&P. So higher highs, lower lows, and the time frames are compressed. NASDAQ is high beta versus the S&P. Wave 4, we get a 61.8 retrace, and then a bounce higher. And if the S&P really trended sideways between May and January last year, not quite sure of the NASDAQ. You had a sort of a sideways band here, but then it took a decided leg down in September, stayed down there until January, before which it just moved. You can see the volume by price pattern here. So again, lots of accumulation here at the lows. And again, I would argue, and it's you can't prove it yet, but my opinion, my argument would be this volume spike here is the same thing. This is people who missed the opportunity to load up down here, were able to, again, by coincidence, good fortune, whatever method, were able to exploit this sell-off right now and pick up some NASDAQ positions here. And I think, again, when this turns around, I think it is going to turn around pretty soon. I think we're on for a run to a wave 5 higher than NASDAQ. Now, wave 5's again, that termination point between the 61.8 and the 78.6 extension of waves 1 to 3 combined. So this would see the QQQ peaking somewhere in the mid 400s. Now, we've said in previous webinars, this probably a conservative chart. There's a really good argument, I think, that this isn't a 1, 2, 3, 4, 5. I think a really good argument exists to say that the COVID low was the low and should start, so that should be a wave 1 down. In which case, that's a 1 up here. That's not a 4, it's a 2, and we're in a 3. And if we're in a 3, it's going to go a lot further than the mid 400s. That isn't today's problem. Today's problem is see what happens when it gets to these mid 400s and see if it rolls over or not. If it rolls over, it was a 5. If it doesn't, it keeps going, it's a 3. That's a critical decision for us to make here. If you're selling because you think it's a 5 and it turns out it's a 3, that's a whole lot of surrender profit. So that's a critical one to get right, not today's problem. Today's problem is, has this bottomed out? And again, I think probably it has. Maybe there's another move down, but if it is, I don't think it'll be a big one. And then we're going to move to a new all-time high, and that remains our working thesis. Let's look at the NQ futures. Again, really nice, clean chart. So from the January lows, wave 1 up, 2 down, 0.5 wave 2 retrace, a 200% wave 3 extension, a 38.2 wave 4 retrace, classic A, B, C correction, we've had, I think, about this is an older chart from yesterday. We've pretty much had a triple bottom now. If you look at where the futures dropped to today, that's pretty much a triple bottom test from 21st of August, 26th of September, 27th of September, and then today. So that's held us support pretty well. And I think that will continue to hold us support. And I think that we're then on the move up for, again, a wave 5 that will typically terminate between the 61.8 and the 78.6. So let's call that 18,000 on the futures, which is, again, probably an all-time high for the NASDAQ. Let's do the Dow DIA ETF for the longer term. And this is particularly interesting, if you ask me, because there was no buying down at this spike low in October. I mean, just look at the volumes. There isn't any. So where in the S&P, the accumulation started in May, and you would have seen in the S&P big volumes here. Didn't happen in the Dow. Nobody started buying the Dow until it bounced back up above this, 320 level. So I think the reason that, well, put it another way, the happy coincidence and good fortune that people have been able to keep buying in this zone, which, right now, the Dow is back at a level where it was in June 22, or more recently in May this year, it's a do-over, right? It's oops, I missed down here. I missed the opportunity to buy here, but now I get to a do-over and get to buy up here now. So again, it could be distribution this, but I don't think it is. And I think the Dow, for me, is the tell for the other indices, because look, people just weren't buying the Dow down here. They should have been, but they weren't. And so I think this is, okay, we need to load up here in advance of a new move up to all-time highs for the Dow. Let's look at the YM futures. It's been a rough sell-off, this one, for the Dow and for the Russell. So we got, very near term, we got from May a 1, 2, 3, 4, 5 wave up into the July peak, and then a really, really big ABC correction down, where the low today was, barely above the low that was struck in May, but it was above it. So that, that's a higher low. And so this retrace, the ABC retrace, didn't correct all of this 1, 2, 3, 4, 5 waves up. So for now, that's bullish. The Russell's been the weakest by quite some time, quite some way. If you look at this again, it's a very similar chart to the Dow. So May we get this 1, 2, 3, 4, 5 waves up. Russell is, again, pretty hyperactive. So the amplitude of the moves is bigger than the Dow, a bit more time compressed as well. But if you look at, the overall move up from May was corrected, but not completely so. And also, if you look at the perfect A equals C, where the A leg is equal to the C leg down, the opening point of the Russell today on these futures was at exactly to the dollar, the A equals C. So that may prove meaningful or not, I don't know. But what that says is that of course there could be more downside to come, but probably there isn't much, because so far the market's decided that it does not want to take out all of this move up from May. So it looks to us, while we're at it, just finish off with the IWM, that's the Russell ETF. It continues in this accumulation zone that we've been tracking since May last year. And it continues with this, higher low pattern. This is this green support line here. So it's slow, painful, plenty of head fakes, but that continues to look like accumulation. And just look at the volume as it ticks up within that this price range. So continue to expect the Russell to break to the upside. When it does, I expect it to break that resistance line and shoot up through this markup zone in the same way that it did back in 2020-21. This will be a low volume run up, and I would expect profit taking up here in the distribution zone when that happens. That could be a year away, could be more, but that's the pattern I would expect here. Okay, before we move on. If we've got any questions at all, now's a great time to do it. So if you're new here, plenty of ways to ask questions. The easiest way is use the audio system here in the webinar. So unmute yourself and shout into the system. If you don't like to do that, or you can't use audio where you are, then you can use the chat or the question function here in the webinar platform. For those of you who are Growth Investor Pro users, you've got the Rocket Chat members chat room. You can use that too for questions. Okay, nothing right now. So what I want to do now is I want to move on and look at, which stocks, single stock names, are in our accumulation zone. Now, again, if you're new here, let me just walk you through how we think about, buying and selling stocks. I'm just going to put a new page up. Just 1 second while I do that. Here we go. Okay, so this is the simple motif to which we work. So we use the Wyckoff rotation method. This is an idealized version. It's not what reality looks like, although reality gets pretty close to this quite often. So we label our stocks in 3 ratings. Accumulate, which means we think that large account players are buying the thing slowly, building up position at the lows. We then, as they move up, label them markup, which is where we see relatively low volume, high price, high rate of change price increases. Distribution is where we think large accounts are selling at the highs, again, textbook sideways action, typically high volume. And markdown is where we think the bigs are done selling. There's, again, no volume because this is just retail getting out long time after they should be. And this is the cycle that we try to follow. And it's worked pretty well for us. So you'll recall, if you were here last year, that we called accumulate on many tech stocks, which have since moved into markup and have offered 50, 60 plus % gains, and not just Nvidia, but many other stocks. Some of those, as you know, in personal accounts here, we've cashed out and taken profits on, others we hold. And we think that they're going to continue to move up through markup and offer distribution opportunities in due course. So what we're looking at right now is we'll get an opportunity to move to reach those distribution zones. We had that with Iridium, with Maxar, and a number of other companies at the back end of last year. Value stocks were peaking at that point. These growth names, I think, will peak in the distribution zone. They're not there yet. And so what's interesting right now is not so much selling things as looking at, well, what stocks have been held down and not taken off this year, or have been hit hard by the recent sell-off, and which are back in these accumulation zones. So let's take a look. There's 4 I want to highlight. The first is Autodesk. Let's just say 4, I should say, with really strong fundamentals. So Autodesk, ADSK. Let's look at the stock chart first. Okay, so here we have, let's just track back in time a little bit. It's a weekly chart. And here we have the start of a move up from February 18 lows. We get a 1 up, 2 down, a 3 up, 4, 5, featuring basically that is a larger degree wave 1. Like that. Okay, from this wave 1 high, we then get almost a 78.6 retrace down to here. And if remember, it took February 18 until August 21, so more than 3 years to add that. And then from August 21 to these lows was less than a year. So 3 years up, less than a year down. And the stock has started to move up. So from these June lows last year, 2022, we get a 1 up, a 2 down, another 78.6 retrace of this wave 1 up. And you can see the stock in this, you can see the wedge forming here, and you can see it within this accumulation zone. You can see this big spike in volume here. Now, my own opinion is this is in anticipation of significant improvement in Autodesk financials. Autodesk is the go-to computer-aided design software company. And so it's a beneficiary of any big CapEx projects in pretty much any industry you can think of, with the possible exception of semiconductors, who tend to have their own suppliers. And so if you think the economy is going to continue to improve, if you think that the cost of money is probably going to come down over the course of the next year or two, not back to zero, but down from where it is today, then you would expect CapEx to pick up. And if CapEx picks up, you would expect Autodesk to do well. And I think that's what the market is anticipating. If we look at Autodesk fundamentals, they're pretty good. And they've started, I think, to turn around already. So if you just look at a very simple measure of quarterly revenue and growth, so growth troughed at 8% in the April quarter, still pretty good considering what the business does. That's down to its business model, much of which is subscription. But we've got the first tick up in quarterly growth rates in the July quarter. First time that growth rate has accelerated since April 22. Trailing 12-month growth, you've still got 10% growth, which, given the business is on a $5 billion revenue base, that's not too shabby. Margins are great. So you have 51% unlevered pre-tax free cash flow margins. That's not, accounting earnings. That's not, adjusted non-GAAP EBITDA and all that rubbish. It's actual cash flow. So it's pretty incredible. 10% organic, 10% revenue growth, I should say. 51% cash flow margins. You don't see that very often. Balance sheet, safe as houses. So there is some leverage, but overall, the company is just tilted into a positive cash position. $10 million in net cash, leverage, gross debt $2.3 billion. But I mean, if you look at the cash flow available to service that, this is nothing of any great import. The other thing to look at is if you look at the rate of growth of the order book remaining performance obligation is growing at 13% a year. So it's growing faster than revenue. And the order book is about the same size as last year's revenue. So RPO of around $5.2 billion is roughly equivalent to all of the last 12 months revenue. So you've got a big order book growing faster than revenue. You've got revenue accelerating, 50% cash flow margins, rock solid balance sheet. That looks pretty good. So we rate Autodesk at Accumulate. We have good expectations of that one. Let's do the next one. So these are 4 stocks we have at Accumulate that have rock solid positive fundamentals, and we'll do 4 stocks that have not such good fundamentals, but we think the stocks can move anyway. So next one, good fundamentals, Datadog. Observability software business, sells to enterprises to help those enterprises watch their other aspects of their other IT deployments, so other software applications, hardware systems, and so on. Competes with Splunk, that was just acquired by Cisco. That acquisition, I think, will help Datadog because Datadog will remain a single-purpose organization. It won't have all the clash in sales teams and developers leaving and all those things that will happen once Splunk completes that acquisition by Cisco. Datadog started a low in the COVID lows of $30 a share. It went up to $200 a share within just over 18 months, and then put in 78.6 retrace. So again, you can see these stocks trade really, really nicely to fibs and waves. It's not an accident that they so often fall to this 78.6 retrace level. That's a pattern, repeatable pattern. And briefly moved up into our markup zone, back down again to Accumulate. You can see this, huge volume spike down here. Remember, the clock starts here at the all-time highs. So this volume is all stock that's been bought here at the lows. It wasn't stuff that was bought when it was trading sideways back here. This has all been acquired, since the middle of 2022. We think the stock is basing for a really nice move up. Stocks that are this volatile on the way up and on the way down tend to be this volatile again. So although that wave 3 looks fanciful, it's not really. It's just a standard wave and Fibonacci technical pattern. 1.618 wave 3 extension of that wave 1 is not particularly aggressive for a stock like this. And if we were to look at the fundamentals here, this is Datadog on the screen right now. Again, fundamentals are really good. Datadog needs to start to turn around its growth rate. So it was growing at 84% at the peak in December 21. That slowed to 25% in the June quarter. They're guiding to 20% growth for next quarter. I would be surprised if it came in that low personally. If we look at the order book, the order book is growing at 42% a year now. And the order book's only worth 2/3 of trailing 12-month revenue. So just because the order book's growing quickly doesn't mean revenue will grow quite as fast, but nonetheless, the tick up in growth is great. So order book growth troughed at 30% in the December 22 quarter, then up to 33% in the March quarter, 42% in the June quarter. That's a great trend. And so probably this revenue number, this revenue growth rate will start to tick up. Gross margin, superb, 80%. Cash flow margin, 17%, which, okay, it's not Autodesk, but on the other hand, Autodesk isn't growing TTM revenues at 39% a year. Balance sheet, nearly $1.5 billion in net cash, so safe as houses, and plenty of recurring revenue and deferred revenues we've seen from the order book. So really nice, solid fundamentals Datadog. And again, I think this is going to benefit from the sale of Splunk to Cisco. New Relic already got bought as well by private equity. Splunk's gone now. So amongst the independents in observability, that just leaves Datadog and Dynatrace, DT, both of which I think can benefit. Okay, next one is Cloudflare Net, N-E-T. Let's look at the chart. There we go. Now again, crazy volatile, but it does trade nicely to Fibs. And the chart method we use here is to start at a notional zero, which can work for these recent IPO, crazy volatile names. So we get a 1, 2, 3, 4, 5 waves up into the peak at 2021, a rapid dump in 22 down to the 78.6 retrace from a notional zero up to the all-time high of 222, and then this just huge sideways action down at these lows. And again, my interpretation of this is, it's apparent to lots of people now who invest in tech that Cloudflare is a structurally important business. It does two things: content and application acceleration on the one side, and security perimeter services on the other. And it's FedRAMP approved on the latter. It's a good number 2 player to Zscaler that we'll talk about in a moment, and a company that's of some strategic import. Now, I don't think people knew that back in 2020, 21. They just thought it was a thing that sped up your funny cat videos. And so lots of institutional investors failed to bother to notice it, didn't invest in it. But believe me, they will have noticed it once it was up here at the 220s and started featuring, everywhere and getting Fed certified. So this here is a golden opportunity, I think, if you're a big money investor, to start to accumulate at these lows. Remember, it's a relatively small cap stock, just a few $1 billion of EV. And therefore, you can't buy great gobs of this stuff without moving the price. And so it's going to take a long time to accumulate. But when the bigs have enough of it, I think you'll start to see some very positive media stories about it. You'll see some stories about how it's of national security importance and all that kind of stuff. And I think we'll see the stock break to the upside. Now, the markup zone we have here is very, very cautious. I mean, I wouldn't be at all surprised to see it make new highs within a couple of years. So how long you choose to hold it for, that only you can decide. It's going to be volatile. It will have big drops if it misses earnings. It will rocket if it trounces earnings. It's not a relaxing hold, but none of the good ones are. And so we think this is a stock that can go all the way. We think it can be a really big success over the next 10 years. And it also offers endless great trading opportunities just because it's so very, very volatile. It's right at the top of our accumulation zone right now. So it closed at just under $60. And my guess is it's not too long before this breaks to the upside. If we look at the fundamentals, the thing that the company is doing much better at is it's working towards being cash flow positive. So it put in one cash flow positive quarter, which was December quarter last year. It then tipped back into negative, but you can see the negative cash flow margins are declining all the time. In other words, it's trending towards positive cash generation. Growth, again, they need to turn it up a bit. 32% revenue growth in the June quarter, 39% on a TTM basis. It's $1 billion of trading revenue. So again, it's not a huge business, but it's a good growth level. Accounting earnings, which we present here as EBITDA, look good. You can see they managed to this because the trend is picture perfect. It improves every single quarter and has done since June 19. But there's a lot of capex in this thing, and they don't collect cash very fast. So change of working capital is almost always negative, which is what the big capex spend on servers and the failure to collect cash quickly enough is what contributes to this negative cash flow. So I think at some point in the next few quarters, this thing will start to generate positive TTM unlevered pre-tax free cash flow. And at that point, I think you'll see people get much more excited about the stock, particularly if the growth is held up. Remaining performance obligation, so the growth rate here, 32%, about the same rate as revenue-ish. Order book's big, 90% of trailing 12-month revenue. And so I think, again, next quarter, they're guiding to 30%, so it's a down guide. I'd be surprised if they did that. I would expect to see at least flat and maybe 1 point of growth. They're cute. They understand how to play the capital markets game better and better, I think. And so I wouldn't be surprised at all to see that come in at 32.5 or 33% growth just to demonstrate some acceleration. So that's Cloudflare. Last one, strong fundamentals and stocks sold off. Zscaler, ZS. So this is a pure security player. It's the leader in something called Zero Trust. So if you're an enterprise or a government customer and you want to throw basically a protective ring around your network, the way you do it is you use Zscaler's online service, and you force your network assets to effectively only trust one party, which is Zscaler, and you let Zscaler decide whether an incoming network connection, be it a device, a user, an application, a microservice, whatever it might be, you let Zscaler decide whether to trust that or not. Your network operates on what's called a zero trust basis. Zscaler is a terrific business and run by a 5 times successful now CEO, sold 5 businesses before, and this is his 6th, which is already a big success, and I'm sure will continue to be so. Super volatile stock. So from the COVID lows at $35 a share, it puts in a huge run up to $375 within the space of just over 18 months. Gives up all that gain, or 78.6% of that gain, down to the lows of 85, which was struck in April this year. Actually, it had a sort of final leg down in the first and second quarter this year, and then it's trended right up to the top of this accumulation zone here. Now you can see again the volume spikes here. Same reason, I think. I don't think anybody was really clued in as to the importance of Zscaler back here. No volume at these prices. I mean, even if you start the volume clock at the COVID lows, there's just no volume at the high at all. So that's just retail up there. Back to the clock at the highs. This is major accumulation, in my opinion, down here. And I think this thing, again, is getting ready for a break to the upside. If we were to look at fundamentals on Zscaler, again, it's not a big business, $1.6 billion of trailing revenue. Really, really solid fundamentals. You've got a business growing 43% growth this quarter, 48% on a TTM basis. Guide is 33 next quarter, but again, I'd be surprised if it doesn't beat that. Cash flow margins 10% on a TTM basis, which again doesn't sound much, but 48% TTM revenue growth, 10% TTM positive free cash flow. That's a pretty good blend. Almost $1 billion now of free cash on the balance sheet. There is some loans, but it's more than counterbalanced by the cash and short-term investments. And the order book is huge. So the order book is worth 2 times, better than 2 times trailing 12-month revenue. And the order book is growing at 35 points a year, which is, I wish it was a bit faster. So key issue with Zscaler, particularly for valuation, I think, is, they need to show some acceleration in revenue growth. Confident they'll do that, but they need to start doing it in the next couple of quarters, I think, or the stock's not going to take off for a while. But very positive on this one. Cybersecurity is a category not going away anytime soon, I don't think. And Zscaler is a top pick in that sector. Okay, so that's 4 stocks we rate to accumulate with really rock solid fundamentals. For disclosure, I'm long all of those stocks. Those of you who are in the Growth Investor Pro service will see disclosure alerts whenever I trade in those, buy or sell. So, and you can also see personal account positions on the Stock Central website. Okay, so let's take a look at 4 names that we think are worthy of accumulation, that we think the stocks can go up and do well, but where the fundamentals aren't particularly good. And they are Fastly, Intel, Okta, and Pinterest. So let's start with Fastly. FSLY. Now, Fastly, for the avoidance of doubt, isn't a particularly good business. I'm long the stock because I think it can go up, but there are much better businesses in this world. The company started out its public life as basically a kind of a Cloudflare competitor. It's sold to usually bigger customers, mainly media customers, and it's done less in the way of expanding what it does. It's stuck to the original knitting of content and application acceleration. It doesn't have the security angle that Cloudflare does, and I think they've fallen way behind Cloudflare in functionality and addressable market size. Doesn't mean the stock can't go up. Stock is very much under accumulation right now. They had an activist investor come in some time back, and then people started to get thrown under the bus. So the CEO has been ejected, CFO has been ejected, chairman stepped down. Been a complete about turn in the management team. All excellent decisions, in my opinion, by the board. And the stock looks like it's under accumulation. My own personal view is Fastly will get acquired soon by probably Amazon, maybe Cisco, someone like that, just because Amazon already operates a Fastly type service. It would bring a nice customer base to Amazon's offering and eliminate a competitor to their internal offering. So maybe somebody else, but Amazon I would say is top candidate. The stock in the shorter term, if we were to look at that right now, has been trying to break out. So this is Fastly stock from the December lows here. So we get a wave 1 up into April, a 61.8 retrace, wave 2 down into May, a wave 3 up, not much of a wave 3 up in truth, doesn't quite make the 1.236 extension into September, 0.5. Hang on, that's not right. That's our extension. Let's just plot the retrace. Sorry. There we go. Yeah, 0.5 wave 4 down, and then I think we're going to be in a wave 5 high before too long. So best guess the stock can move from the current 18 up to maybe 25, 26 before rolling over, shedding some of that gain and going again. But on a longer term basis, this is one which we think could be acquired. And if it is acquired for a fair premium from here, you would expect at least a 30% gain from here, probably a 50% gain from here, were it to be acquired tomorrow. That's Fastly. Okay, next one, Intel. Now, Intel has diabolically bad fundamentals. Revenue is in decline. It's eating money for a living. The balance sheet's gone from net cash to net debt. It is not in good shape. But it is the absolute crux and fulcrum of the trade war between the US and China, which is a proxy for a real war in all intents and purposes. Semiconductors are the battleground, and the US is in a big hurry to reshore fabrication of semiconductors. The two big fabricators in this world are Intel and TSMC, and there are other players, but those are the two more strategically important. And Intel is obviously the US's chip, pun intended, in this world. Technically, Intel stock is behaving beautifully. So these are the 2009 lows. We get a 1, 2, 3, 4, 5 waves up that peaked in January 2020. We then got pretty much a double top in March 21. Then the thing just dumps. And it dumps because the company messed up. They messed up on engineering, they messed up on financials, they messed up on product. And any way you can think of, they messed up. Now, since then, they've changed CEO, they've changed strategy, and most importantly, they have kind of a DC push is how I think about it, which is this company has to succeed. If the US is going to prevail in semiconductor, and I believe it will, Intel has to succeed. This low here, struck in September, was a to the dollar 78.6 retrace of the move up from the financial crisis lows. Coincidence? I don't think so. And we've started to get a move up here. So technically, the stock is a bit beyond our accumulation zone. We'd said pick it up between 24 and 34, and the stock closed today at 36. But if you look, there's still pretty high volume, what looks like accumulation, up to maybe 37. So I still think it's sort of viable. And we think that it can make a new all-time high, which is, what that'd be, 68. So maybe a double from here within the course of, let's say, 18 months, maybe 2 years, possibly faster. But I think Intel means to succeed. I think the US government means for it to succeed, and I think it will succeed. So that's Intel. Okta is the next one. Okta is another cybersecurity business, a not very good one in my opinion. They made a complete mess of a big acquisition, a company called OR, $7.6 billion acquisition in 2021 from memory. Everything you shouldn't do with acquisitions, they did. They didn't do their financial due diligence very well, miscalculated the deferred revenue in the business that they were buying by quite some way. That resulted in them tossing the CFO, didn't integrate the sales teams, didn't rationalize the product. Everything you can think of in software M&A, they did wrong. Hence the dump. However, cybersecurity is a consolidating sector, and if you're not a leader, you're getting bought. And I think Okta will probably get acquired, maybe by a financial buyer, my best guess. That would be a graceful exit for the CEO, who I don't think would last long under a financial owner, but would enable him to declare success of a sort. And I think the market is onto this. The stock has been under, I think, high volume accumulation between around 63 and around 83, 84, something like that. It's currently sat at 78. We've got our accumulation zone going all the way up to 100. But naturally, if this is one you're interested in, you should try and buy down here in the lows of the zone. I think the break to the upside, my guess, will come not so much from organic improvements, although the company is putting in better numbers now. It's a sale. And so I own Okta. I'm underwater with it. But the reason I own it and haven't just got out of it is because I think the company's going to get sold. We said that a few times successfully of late. Splunk, we were correct on. Various others in the past. A number of cybersecurity businesses, Sale Labs, we said, Perspecta in federal consulting. So our calls on M&A are pretty good. We can be wrong, of course, but I think this is shaping up to get acquired. So I'm happy to keep owning it for that day. And then lastly, in the guise of not great fundamentals, but stock in good shape, Pinterest, which is a consumer internet business. Consumer internet, not really our thing, but Pinterest is caught my eye because actually, the fundamentals are better than you might think. It's not particularly high growth these days, but it's cash generative, big fat balance sheet from the IPO cash. And again, they had an activist investor in the shape of Elliott Advisors join the shareholder ranks some time ago. Q, complete change in the management team, big shake up of how the company was run. And the stock, as you can see, just started to enter this big accumulation zone between around $19 a share on the low end and, you could say 30 on the top end, but really 27. And so we think this is most certainly worth picking up and accumulating. It could break out through organic growth, but again, most likely I think this one gets bought. There's been various rumors in the past of it getting acquired. None of those proved true so far, but I think this one's going to get picked up. So the 4 stocks we think accumulate rated, not wonderful fundamentals: Pinterest, Okta, Intel, and Fastly. And then the 4 stocks that have great fundamentals and very buyable stocks, we think: Autodesk, ADSK, Datadog, DDOG, Cloudflare, NET, and Zscaler, ZS. Okay, that's what I wanted to cover today. So if we have any questions at all, now's a great time. You can either fire them into the system, just shout at the system, or you can post them in chat or in questions here. So far, nothing. And so what we'll do is finish up for the day and post the recording later on. Someone just open the mic?
Yes.
Hey, who's that?
Oh, Kyle.
Hey, how you doing?
Intel, it seems like there was news about it either selling or spinning off part of its line today. Do you think that has any effect on it?
Yeah, it's the FPGA business. I think they call it the Programmable Solutions business, something like that. I think that the Intel team, the new CEO, are pretty good capital allocators, and I think they have found that. I mean, I tell you what, let's call Intel numbers up for a second. Just one moment, because this is driven by the balance sheet. So let's just get this on the screen. Hold on. Let's just zoom in a little bit. Okay, so Intel has a horrible balance sheet. Okay, it's got $19 billion of net debt, and the last 12 months unlevered pre-tax free cash flow was negative $23 billion. So if it wasn't called Intel, creditors will be all over this thing. It reminds me of Boeing a couple of years ago, where Boeing was just bleeding cash and was levered, to the eyeballs, but nobody called the loans because it was called Boeing. In fact, 16 banks got together to refinance it. And Intel has that, US corporate royalty status. But you can't run that kind of negative cash flow, which is driven by building fabs, amongst other things, and have that level of debt for very long. And so I think they learned from the Mobileye spin that if you have a business that they think can generate value outside of Intel, I think they see it as a capital allocation, capital raising exercise. So my guess is it's probably positive for the Intel stock. I haven't read the latest detail, but my guess is that they will remain a really big owner of the business after the spin happens, as happened with Mobileye. And so I think it's probably smart. I think they'll get most of the earnings benefit through their large shareholding, and I think they'll get to realize some cash for the business. So I think, based on what I've seen, I think it's a positive move. Yeah. I hope that helps. Any other questions, folks, before we finish up? If so, now's a great time. We've got a few minutes left. If not, if you think of a question later on, then just post a question to the YouTube recording or any other method you have to get hold of us, be it on Seeking Alpha or Substack. You can always fire questions in. Okay, let's finish up for the day. So thanks everyone for joining. Hope you found it useful. Again, always open to taking questions or comments of any kind later on once you think of them. Recording will be live in a couple of hours once it's compiled on YouTube. Thanks again for being a member of our services. All the services in our business continue to grow just brilliantly, which is very flattering. And hopefully we'll continue to generate good ideas for everyone and provide services you find useful. So thanks again. I'll speak to you all soon.